Hey guys, how's it going? It's Andy from Magoo Investing. Happy Tuesday. Today, instead of talking about individual stocks, I wanted to have a discussion about the overall stock market. And so if that's not something you're interested in, I'll be back tomorrow with my normal breakdowns of the different stocks. But there have been some things happening in the stock market for the past couple days and going into last week that have kind of spooked me a little bit. So in today's video, I kind of wanted to talk about some of the things that I'm feeling about the overall stock market. And I know people don't like it. A lot of people want to come to my channel and hear me be very bullish on everything, because things are good when the stock market goes up. But there are three things that I've been seeing in the stock market that has me feeling like we're going to have some sort of stock market crash in the future. And when I say stock market crash, I don't mean some catastrophic meltdown where the stock market falls like 40% in a couple days. But I'm kind of betting at this point that I think the stock market's going to have a correction early in 2021. A correction is a 10% move. Going into a bear market is a 20% move. So this is kind of the reason why I have the most amount of cash sitting in my portfolio that I've ever had. And if you want to see exactly what stocks I own right now and how much of a percentage of my account I have in cash, I'll link that video up above right now. But based off of the stuff we saw last week with the IPOs of Airbnb and DoorDash that almost doubled within the first couple days of trading, had me feeling a little bit strange. And I also wanted to show this incredible technical analysis that I saw on Twitter about Airbnb, because it's expected to crash because it would look like a house if it did that. And while I do like DoorDash more than Uber Eats because it loses significantly less money, it's kind of hard to justify a move of 100% from an IPO. And I've always talked on this channel about IPOs being a risky investment if you want to buy into one of these, because it's very difficult to judge the value of a company and put it on the stock market and see how the investors actually feel about it. And so we've seen some of the IPOs that were supposed to happen towards the end of the year with Affirm and Roblox delaying their IPO to try and get a better valuation before going public. So we're seeing a lot of hype around these IPOs recently, and it's making me feel a little bit strange about the stock market. So I did some research, and I've come up with 3 reasons why I think that the stock market could crash in the upcoming month, and I kind of wanted to share those in today's video. And so I want this to be a discussion, so I'd love to know how you guys are feeling about the overall stock market in the comment section down below. But before getting started, I do have to say that I'm not a licensed financial advisor, and this is not financial advice. Anything you hear in this video is just me giving my own opinions on the stock market, and you need to do your own research before making any investment decisions. Also, if you've been enjoying these videos, really appreciate it. Hit that like and subscribe button, as it would help my channel out a lot. Also, I do have a second channel now, and that'll be the top link in the description if you want to go learn more about financial education and just kind of the basics of investing. Okay, so reason number 1 why I think the stock market could crash in the upcoming month has to do with greed. And so one of the most famous investing quotes I feel like most people have heard at this point comes from Warren Buffett, talking about how you should feel fearful when people are greedy and greedy when people are fearful. And if you looked at the market right now, I feel like most people would agree that people are being very greedy at this point. But I wanted to look at some of the numbers that kind of back up and kind of quantify how greedy people are feeling right now. And so there's a couple things that I like to look at. The first one is the greed index. This index looks at the number of stocks hitting 52-week highs compared to 52-week lows. And based off of that, it's considered the extreme greed area of this index. Also, the S&P 500 is showing extreme greed by being above the 125-day moving average by 8.3%, which compared to the last 2 years shows extreme level of greed as well. And then looking at the put-to-call ratio for options is currently sitting at 61%, making it on the lower end of the entirety of 2020 showing greed. And currently the NASDAQ is up almost 100% in the past 2 years. And this article I found talked about the results of some of the bubbles that we've seen in the past century. And so this article talked about the percent based off of the 2-year move of the overall stock market, the percentage that the bubble bursts. And based off of the 100% move that we've seen so far with the NASDAQ in the past 2 years, the article says that we have around a 50% chance of a bubble popping. A bubble popping would be a huge downside move to the overall stock market. The last 2 bubbles that we've seen, we saw the housing bubble, which cratered housing prices, and then we saw the dot-com bubble bursting in 2000, which shot the NASDAQ down, I think it was like 60% or something like that, and it took up until 2015 to recover. So 15 years to recover from that bubble. Also, I wanted to point out that we had the best November since 1928 and the best overall month since 1987. And so if you've been around the stock market or you know a little bit about the history, you'll know that 1987 was a huge year for the stock market, and not in a good way. October of 1987, you have what is considered Black Monday. Black Monday was a day that the Dow Jones fell by almost 23% in a single day, and it's the largest drop in the history of the stock market. So recovering a little bit the following month after that massive crash makes a little bit of sense. But does it make sense to have our stock market, which has been rallying for the past, 6 months, have the best month since that point? I personally don't think so. Also, a fun fact from that is that Black Monday created circuit breakers, which are put in place to halt the trading of the overall stock market if the market falls or goes up significantly in a certain amount of time. It's kind of the idea that a lot of the panic takes over and you have panic selling. And the idea of the halt is that it gives 15 minutes for investors to read more about the information that's released about the overall stock market to try to remove as much emotion as possible. And we have this with individual stocks, where a stock will get halted right before major news comes out that's expected to move it significantly. And yeah, so that was implemented after Black Monday. And in March, we saw that 4 times happen. So that is the first time I've actually seen that in action. And it was fascinating to watch, even though the stock market was crashing at that point. So reason number 1 of greed, we've been seeing some crazy levels in 2020. And I don't think it's justifiable based off of the history of what we've seen with the stock market. So number 2, I wanted to talk about IPOs and SPACs. And so I've already talked about Airbnb and DoorDash's IPO and how crazy they were. This is something where if you got in early, you could have made a lot of money, but it does not make a lot of sense that these people that are getting paid millions of dollars to find the correct valuation of these companies are missing by a significant amount, by 100%. And so I've been seeing some people, a lot of people I actually really respect, like Jim Cramer, comparing these IPOs to the dot-com bubble bursting in around 2000. But I think the scarier part comes from the huge increase in companies electing for SPACs instead of the traditional IPO. So the traditional IPO process, you have to go through the New York Stock Exchange, and there's a bunch of criteria that you have to meet to be able to list on the stock exchange. But going with the SPAC as an acquisition company allows these companies to kind of avoid some of the hurdles that make it difficult to become a publicly traded company. And in the past couple years, we've seen a massive increase in the popularity of this method. And so as I mentioned, the amount raised in 2014 was $1.8 billion from SPACs, and that number is expected to hit $15 billion in 2020. So that is a huge increase in just a couple of years. And I wanted to compare this to the dot-com bubble of 2000 because I think I see a lot of similarities between the two, and a lot of the crazy movement that we've seen with a very popular SPAC, which I'll mention in a little bit, kind of justifies me trying to compare them. And so during that bubble, internet stocks were all the rage, with almost 40% of all the venture capital in 1999 going to those internet companies. And I just wanted to read this explanation that I found about the dot-com bubble that I found on Investopedia, and I want to compare it to a well-known stock in a second. So companies that had yet to generate revenue, profits, and in some cases a finished product went to market with IPOs that saw their stock prices triple in one day, creating a feeding frenzy for investors. And I want you to think about a very popular stock from 2020, see if we're on the same wavelengths. When I think of that definition, I think of Nikola. So Nikola has a hydrogen and electric truck that didn't actually run, so it didn't have an actual product. It had a lot of speculation about their Badger truck, which had a lot of hype behind it, but it didn't have an actual working model at that point. Their entire revenue came from installing solar panels on their founder, Trevor Milton's house, and analysts claim that their founder lied about their tech capabilities with their battery. And so at this point, we're seeing a lot of similarities. They had no revenue, no profits, and in some cases, they did not have a finished product. And we saw a lot of hype behind Nikola, and I'll put up the 1-year chart. You're going to see how crazy of a year it's had. There was so much hype behind it, and then you started to see some of the cracks in the actual company. You saw the revenue numbers come out, their CEO and founder step down. And so it just shows that a lot of the people that are quote-unquote investing, it's mainly based off of speculation and not based off of the actual company and the product that they're producing. And I think that's really scary. And so SPACs are used to avoid some of the requirements set by the New York Stock Exchange by having a certain market cap, certain profits, or a certain level of revenue. And so you only have to meet a couple of the criteria. But for a company like Nikola that didn't really have a working product at that point, had very little revenue, I think it was like $30,000 from installing the solar panels, and no profits, this was a way that the company could get a lot of capital based off of going public, but not actually have the requirements to be on the stock exchange. So that brings a lot of very popular stocks that are mainly built off of speculation and not based off the actual underlying company. And I think that's very comparable to what we saw in 2000, when a lot of these companies were just building up a name brand to try to be recognized with this boom that we saw with the internet companies. And then when the stock market crashed, a lot of these companies didn't actually have the financial capabilities to survive a crash and survive through it. And I'm kind of worried that we're going to see similar things. We've been seeing the trend of SPACs are becoming more popular to kind of circumvent these regulations that are put in place by the New York Stock Exchange, and that scares me a lot. So that's reason number 2 why I think that we could see a stock market crash. we've been seeing a switch of IPOs being the most common way of listing on the stock exchange to SPACs becoming the kind of preferred way to go on the stock exchange, but it has so much risk because you're buying a company based almost exclusively on speculation and hype, not as much on the actual strength of the company. So that worries me a lot. And reason number 3 has to do with changes to the overall stock market that we've seen in 2020. 2020 has seen a lot of changes for pretty much every part of the world, but I think the stock market has seen some significant changes, and mainly that has to do with the lockdowns that we've been seeing. So we came out of the longest bull market in history of the stock market, which was over 10 years at that point, and then we went into a global pandemic. The stock market crashed, and then we had the shortest bear market in history as the stock market recovered back in April. And so during that time, we've been seeing retail traders be more impactful. In the past, retail traders only made up, it was 10% of the actual trading volume in 2019. So that it is a part of the overall stock market, but they didn't have as much weight as what we've been seeing in 2020, where that number has gotten up to 25%. This is comparable to the dot-com bubble when online trading became very popular and resulted in some crazy moves in price. And I feel like we've seen that in 2020. One of the examples I would think of is Tesla. Tesla is a fantastic company. I have nothing against it. But does it justify a 650% increase in 1 year? Maybe not. I think it's a huge reason because of the increase in retail traders and the popularity of investing in the stock market. And so we've been seeing some very interesting things. Another example I want to point out has to do with Hertz, which filed for Chapter 11 bankruptcy in May. And just when it looked like the stock price was going to continue to fall and go to zero eventually, retail investors came in and kind of saved the day. And so Hertz stock jumped from 56 cents to $5.50 over the next 2 weeks. So after declaring bankruptcy, 171,000 retail investors on Robinhood decided that would be a good idea to buy the stock. And it's actually really interesting because, this is a bankrupt stock, and Hertz actually tried to have a stock offering during that time to take advantage of the popularity of the stock and the ridiculous increase in price to try to raise money to avoid going bankrupt. And the SEC did deny that because they're going to be worthless stocks. But it's just a really interesting example of retail traders being able to prop up a bankrupt company that these millionaire and billionaire investors are running for the hills away from. And retail investors are like, sure, I'll buy in. I have nothing against that. We've been seeing that a lot with the airline stocks, the cruise stocks, and just stuff like that, where retail investors are buying stocks that the professionals wouldn't even touch at this point. So it's been a major change to the stock market. And while this isn't a huge reason for why I think the market could crash, it does worry me a bit because it's hard to predict where these retail traders are going because they're buying bankrupt stocks. So I think it's very difficult to judge where the market's going, and that's why I put it as number 3 on this list. So just to summarize, the 3 reasons that I'm worried about the stock market crashing in the upcoming weeks or months has to do with number 1, greed. Number 2, the switch from IPOs to more SPACs because they don't have the backing of an actual company like we do with the IPOs that have the requirements set by the New York Stock Exchange. And then number 3, we've been seeing some changes in the stock market that makes it very difficult to predict where money is going to be moving in the next couple of months. So those are my reasons why I'm a little bit wary. I am not expecting a major crash, not like a 40% move. I am expecting a correction, which would be around 10%, and I'm going to be looking to use the money that I have set aside to buy back into the market and take advantage of that. But right now I think it's like 30% of my account sitting in cash, so I'm going to be very patient, and I do have 70% still in the market. So I'm going to be able to take advantage of if the wave just continues to ride higher, because I do have money still in the market. So let me know what you thought about my video. Let me know what you guys are feeling about the overall stock market, and I will see you tomorrow in another video. So thanks for watching.